Most people shopping for a car will spend hours comparing interest rates. They'll agonize over the difference between 6% and 7% on a loan, and look, that matters. But it's not the number that's going to cost you the most money, not even close. A brand new $50,000 car loses roughly $28,000 in value over 5 years. The interest on the loan for that same car, somewhere between $7,000 and $11,000. Depreciation is the single biggest cost of owning a car, bigger than fuel, insurance, and servicing combined. Yet nobody walks into a dealership thinking about it. So the real question isn't just how you finance a car, it's how you minimize the total cost of having one. And in Australia right now, you've essentially got 3 paths. You can buy with a standard car loan. You can salary sacrifice through a novated lease. Or if you're going electric, you can access what is arguably the best tax concession available to Australian employees today. Each one makes sense for a different person in a different situation. Let's break down exactly where the money goes. Starting with the thing nobody wants to talk about. A new car loses 10 to 15% of its value as soon as you take it home from the dealer. And then that depreciation curve tends to flatten out a little bit at the 3 to 5 year mark, with another notable drop when the factory warranty expires. So your $50,000 car? After 5 years of roughly 15% annual depreciation, it's worth around $22,000. That's $28,000 gone. Now the same model bought at 3 years old for around $30,000, hold it for another 5 years and you lose roughly $12,000 to $14,000. That's a difference of about $15,000 more than the total interest on a typical car loan. It works regardless of how you finance it. Now car loans, there's a gap here that catches almost everyone. When you search for rates online, the numbers range from about 5% to 10%. The lowest things like the RACV green car loan at 5.09% are reserved for secured loans on new or near new vehicles going to borrowers with excellent credit. But the RBA reports that the average fixed term personal loan rate including car loans is 9.68%. That's nearly double the best advertised rate. On a $40,000 loan over 5 years, the difference between 6% and 10% works out to roughly $4,000 to $5,000 in extra interest. And most comparison websites sort by lowest rate, not the rate you're actually likely to get. Money Smart, that's ASIC's consumer website, says to always compare comparison rates, not just headline rates, because shopping around for the best car loan can save you thousands in interest and fees. But even comparison rates have a catch. They're calculated on a standardized $30,000 loan over 5 years. If your loan amount or term is different, the comparison rate won't perfectly reflect your cost either. Fees like discharge fees aren't included. A couple more things on loans. If you're buying a used car older than about 7 years, most lenders won't offer a secured rate. You'll be pushed towards an unsecured personal loan, and that means higher rates again. And fixed rate means predictable payments. But variable rate typically means no early exit fee, better if you plan to pay it off ahead of schedule. Right? Novated leasing. This is where it gets more complex, but also where the potential savings live, particularly if you're on pay-G employment. A novated lease is a 3-way agreement between you, your employer, and a finance company. Your employer deducts the lease payments plus running costs, fuel, insurance, registration, servicing, tires, directly from your pre-tax salary. That reduces your taxable income, which means you pay less income tax. You also save the GST on the purchase price. Here's the worked example. Say you're earning $80,000 a year and you want a $50,000 petrol car on a 5-year lease. With a standard car loan at 8%, you'd pay about $60,800 over the loan term, add roughly $27,500 in running costs, all from after-tax income, and your grand total out of pocket is about $88,000. You own the car at the end. With a novated lease, you salary sacrifice around $14,000 to $16,000 pre-tax per year at a 34.5% marginal tax rate that saves roughly $4,800 to $5,500 annually in income tax. Over 5 years, that's $24,000 to $28,000 in tax savings, plus around $7,000 in GST savings. Net benefit over the car loan, roughly $5,000 to $10,000, depending on your exact tax situation. But here's the catch the marketing glosses over. At the end of the lease, you must pay a residual. This is not optional. You can't salary sacrifice your car's residual value. It must be covered with after-tax money. The ATO sets minimum residual percentages, and on a 5-year lease for a $50,000 car, That's 28.13%, $14,065 in after-tax cash. If the car's market value has dropped below that residual, you absorb the loss. If it's above, you keep the upside. And those percentages aren't negotiable. They're fixed by the RTO based on an 8-year effective life for motor vehicles. If you release the same car, the ATO now counts the total leased period across consecutive leases, not each one individually. That closed an old loophole. Now here's where things genuinely change the equation. If the car you're leasing is a battery electric vehicle, it can be completely exempt from fringe benefits tax. No FBT, no employee contribution to offset FBT 100% of your lease, and running costs come straight from pre-tax salary. On that same $50,000 car, but electric, your running costs drop significantly. Electricity instead of petrol, lower servicing. Your annual salary sacrifice drops to around $11,000 to $13,000 pre-tax, and the total saving over 5 years compared to buying with after-tax dollars, roughly $15,000 to $20,000 or more. The eligibility rules are strict. The car must be battery electric or hydrogen fuel cell. It must have been first held and used on or after the 1st of July 2022. Luxury car tax must never have been payable on it, meaning the price stays below $91,387. And critically, from April 2025, a plug-in hybrid electric vehicle will not be considered a zero or low emissions vehicle and is no longer eligible. That door is closed. Two things the marketing won't emphasize. First, even though the benefit is exempt from FBT, it is still reportable on your payment summary. That can push up your adjusted taxable income and affect things like family tax benefit, childcare subsidy, HELP repayment thresholds, and the Medicare levy surcharge. Second, the government commenced a review of this exemption in December 2025, due for completion by mid-2027. The current terms could be narrowed, capped, or left unchanged. If you're considering this, there is a ticking clock. Before you make any decision, here's everything else that can trip you up. If you leave your employer mid-lease, the novated lease must either transfer to your new employer and they have to agree, or it gets denovated, meaning you make payments from after-tax income like a regular car loan. Or you pay it out early, potentially copping termination fees from both the finance company and the provider. Novated lease providers may default you to their preferred insurer, which may not be the cheapest. You can usually choose your own, but it adds friction. Management fees from providers typically run $500 to $1,500 a year, often buried in the quote rather than disclosed separately. Money Smart warns that balloon payments can make monthly payments smaller, but the total cost of the loan is higher. They also warn that car dealerships may try to sell you add-on car insurance, including loan protection, gap cover, and tire and rim protection, and that these products are not good value for money. How bad? ASIC found that between 2013 and 2015, consumers paid $1.6 billion in add-on insurance premiums. They received just $144 million in claims, 9 cents back for every dollar. Insurance commissions paid to car dealers could be as high as 79% of the premium. ASIC has since secured over $130 million in refunds and imposed a deferred sales model so dealers can no longer sell add-on insurance at the point of car purchase. On flex commissions, before ASIC banned them in November 2018, dealers could set interest rates on loans, and the higher the rate, the bigger their cut. Roughly 15% of customers were being charged rates 7% or more above the base rate, with no credit risk justification. ASIC's own example showed a difference of over $6,000 on a $25,000 loan. The ANZES/ANDA class action settled for $85 million. Toyota Finance class actions on both flex commissions and add-on insurance remain ongoing. The ban means lenders now set rates based on credit scores, though dealers can still discount rates by up to 2 percentage points. And importantly, self-employed people and sole traders can't access novated leasing at all. Neither can casual workers or employees whose employer doesn't offer salary packaging. The benefit also scales with your marginal tax rate, so higher earners save more from the same arrangement. If you're buying used privately, always run a PPSR check first. $2 tells you whether money is still owed on the vehicle. And yes, you can put an existing or used car onto a novated lease, though financier requirements on minimum value and maximum age vary by provider. So where does all of this leave you? If you're self-employed or your employer doesn't offer salary packaging, a standard car loan on a 2 to 3 year old vehicle is probably your strongest move. You dodge the steepest depreciation and keep things simple. Shop around, don't finance through the dealer without checking what's available elsewhere first. If you're a payee employee with salary packaging and you're buying a petrol or diesel car, a novated lease can save you $5,000 to $10,000 over 5 years. But make sure you account for the residual, the management fees, and any impact on government benefit. And if you're considering an electric vehicle and you qualify, the FBT exempt novated lease is the standout option right now. But go in with your eyes open about the reportable benefit, the government review, and that $14,000 residual waiting at the end. This is general information only, not personal financial advice. Please consider speaking with a licensed financial advisor before making any decisions.